This I'm Al-Mu'izz Al-Makram.
Hello, this is Jia Junhua.
Hello, my name is Lisa Shaw.
We're gonna talk about statement of cash flow, chapter 13, accounting 202. We're gonna do operating activities and investing activities. Also, we're gonna do financing activities. We will discuss these by our group. Thank you.
I will talk about ways of calculating the cash provided or used by operation and the changes of two companies' cash flow statement. For calculating the cash flow or used by operation, both direct method and indirect method can be used. Direct method lists the receipt and the payment of cash for specific operating activities. It includes cash received from customers, cash payments to suppliers for purchase of inventory, and cash payments to employees for salaries and wages. Indirect method begins with the company's net income and is reconciled back to the cash basis in the part of operating activities that are calculated by indirect method. Net income adjustments to reconcile net income to cash basis, which includes depreciation expense, the state of selling land, correct assets, and correct liabilities will be considered. Okay. First, let's talk about the Yahoo company. For the net income for Yahoo 2009 is $605 million, and for 2010 years is $1,244 million. It increased by the $639 million in Yahoo company this year. And the depreciation is increased by 1, and amortization is decreased by $57 million, and the deferred taxes is increased by $202 million, and the no cash items is decreased by $395 million. And the working capital is decreased by $461 million, and the cash from operating activities is decreased by $70 million in Yahoo company this year. So this is the Yahoo company, and let's talk about the Google company. In Google, in the 2009. This is the net income is like $6,520 million, and in 2010, and this is $8,505 million, and this is increased by $1,985 million, and this is Google company is better than the Yahoo company, as we see that. And for the depreciation, and the Google company is decreased by 173, and the amortization is increased by $45 million, and the deferred taxes is increased by $277 million, and the non-cash items is increased by $217 million, and this is the cash from operating activities is for Google 2009 is $9,316 million, and for the Google company for 2010 it is like $11,081 million. It's increased by $1,764 million. It's also better than the Yahoo company. So as we see from the statement of cash flow, we can find that Google company is better than a Yahoo company.
I will be talking about the financing and investing activities on the statement of cash flows for Yahoo and Google. First, I will be talking about Google's investing activities for the year-end 2010. Google invested $10,680 million, which gives a cash outflow of that amount. This is good because it signals that the company is investing and purchasing different property, plant, and equipment rather than selling, which would generate an inflow of cash. Yahoo, on the other hand, did do that. It sold some of its property, plant, and equipment, and it generated $509 million in cash inflow. This isn't necessarily good because it signals that the company had to get rid of some of its long-term assets in order to generate cash for the company, rather than being able to generate that cash from operating expenses. Now I'll be talking about the financing activities for Google and Yahoo. Google's financing activities included $3,050 million worth of cash inflow through the issuance of a new note payable in 2010. This is okay because sometimes companies need to do that in order to be able to invest and keep their company afloat. Since they still have a lot of operating income or operating cash flow, it is not too much to worry about that they have to have some financing activities. Yahoo, on the other hand, had to retire a lot of stock that they had issued because they could not afford the stock that was out already. This is not good because a company should be using most of its financing or its cash outflow and financing activities to be paying off long-term debt rather than issuing or buying treasury stock. In relation to whether or not I would invest in either of these companies, I would say that I would definitely invest in Google because Google had a higher operating activity cash flow, which is great because this just signifies that their day-to-day activities are doing well, and then they had a large outflow of cash and investing activities, which shows that the company is growing rather than having the necessity to sell property, plant, and equipment to generate income. The final thing that I'll be talking about is the free cash flow. This is calculated by having the cash from operating activities less the capital expenditures, and that gives you the total amount of cash that can be used for things such as investment, paying off long-term debt, and other activities to generate growth within the company. Google's free cash flow was $7,063 million, which is 89% of their net income. This is a great number because it shows that their net income most of it can be used to grow the company rather than having to use it to pay off long-term debt. Yahoo, on the other hand, had $505 million, which is only 41% of their net income, signaling that they couldn't really use that as much as they should be able to use to grow the company or to pay off long-term debt. So finally, once again, I will say that I would definitely invest in Google, but I'd be more hesitant to invest in Yahoo. And that concludes our presentation.